implementation of a zero or negative bank rate. The Prudential Regulation Committee had concluded that implementation of a negative bank rate over a shorter time frame than 6 months would attract increased operational risks, and so could adversely impact some firms' safety and soundness. There were a range of views on how the MPC should respond to the findings of the PRA's engagement. The committee was clear that it did not wish to send any signal that it intended to set a negative bank rate at some point in the future. But on balance, it concluded that it would be appropriate to start the preparations in order to provide the capability to do so and implement a negative bank rate if necessary in the future. The MPC therefore agreed to request that the PRA should engage with firms to ensure they could be ready to implement a negative bank rate at any point after 6 months. In addition, and against the backdrop of the recent significant expansion in the scale of the asset purchase facility, the committee also agreed to ask bank staff to reconsider the previous guidance on the appropriate strategy for tightening monetary policy, should that be required in the future. I would like to stress again that neither of these requests, nor any subsequent supervisory actions by the PRA, should be interpreted as a signal about the future path of monetary policy. Instead, these requests should be seen in the context of adapting the monetary toolkit in a world of larger shocks and an environment of sustained lower interest rates globally. As a result, the task of monetary policy has moved from being a choice, albeit not an easy one, on a single dimension, the official interest rate, to a more multidimensional choice, which also involves decisions on which tools to use and which tools to develop, having the box, if you like, for possible future use should the need arise. It is important to be as transparent as possible on tools, as we are doing today, but also to be clear that these decisions are kept separate from signalling about the current or future path of policy setting. They are contingency planning. To conclude, as set out in the Monetary Policy Report, the outlook for the economy remains unusually uncertain. It depends on the evolution of the pandemic, measures taken to protect public health, and how households, businesses, and financial markets respond to these developments. The MPC will continue to monitor the situation closely. If the outlook for inflation weakens, the committee stands ready to take whatever additional action is necessary to achieve it. The committee does not intend to tighten monetary policy, at least until it is clear that significant progress has been made in eliminating spare capacity and achieving the 2% inflation target sustainably. Thank you.
Thank you, Andrew. Yeah, I'm aware there were some technical problems at the beginning of that with some of the audio. We'll be publishing the opening remarks now online and sending it out to you all, so you've got the text. We'll bear with it for now. I think it is improving. So with that to questions, Chris, I think you're first up at the FT.
BC have signed off today include negative rates. Can we take and are more positive than they would be on a constant rate assumption? Can we take that as a view that the MPC sees negative rates as boosting economic activity and therefore inflation? And just a very quick second question is what is the MPC's view on how it's going to vote when it has 3 dimensions in future to vote on, whether it be QE, rates, and guidance?
Well, let's take the first question, Chris. I'm not sure I quite caught your opening words, but I think I got the sense of them. So correct me if I didn't as I go along, and I'll bring Ben or Dave in as well. The market curve, as you say, used in this round had a very small negative number at the bottom of the curve. It's not a very big number, so I think we shouldn't overinterpret what we can read into that. In compiling the forecast, we use very standard interest rate impact analysis to compute that impact. So there's nothing special in there particularly. And as I say, because it's such a small number, been going back to the early days of the MPC, it was, and other central banks as well, it was very much a single dimension in what you might call those normal times that we can hardly remember these days. Nowadays, we do have to take those decisions, and those decisions, we've in a sense evolved the decision-making process, which means that the committee, deliberates, if you like, and out of that comes a proposition on which we can vote. And that proposition, as you can see, has more than one part to it. And members have to express a view on each part. So we've evolved the process of doing that, as I think of other central banks as well. But it is, you're right to point to that. Ben, did you want to?
Sure, thanks, Andrew. I don't think I have much to add. As you say, we've been voting on many dimensions for a long time now. And in this meeting, you'll see we voted on 3 and have been for quite a while. On the first question, as Andrew says, this has been process the effect of changes in the market curve on the forecast in a standard way. We've been doing that again for some time to varying degrees. We actually had slightly less of it this time. There have been negative rates at the front end of the market curve. It's pretty small, so it hasn't made much difference, nor would it were one to attenuate that effect, but that's not what we've done. We've just passed them through an entirely standard way. Thank you. And I don't think it should be seen as a comment on the NBC's views of the effectiveness. It's just a standard approach.
Could I just come in, Andrew, and just to reinforce your points that, as well as voting on a number of propositions as part of this kind of multidimensionality, we also, as a number of us have drawn attention to, it means you can also think in terms of policy overall as a package and how different measures, whether that's QE, the interest rate decision, forward guidance, can complement each other and indeed reinforce each other in terms of the overall impact. So there's kind of individual dimensions, and then there's that kind of what do they add up to aspect. Thanks.
Thanks, Dave. I think Faisal, you're up next. Just give it a second to come off mute. Sorry, I can't hear you at the moment, Faisal.
You're on mute, Faisal.
Right. Okay.
There you go. You're good. Thanks.
Great. All right. Hello, Governor. Just a couple of questions. Can you explain to us how much or what impact the vaccination plan has had on the strength or the timing or the certainty of the recovery? And in terms of post-Brexit trade, you've described the barriers. Would you describe them as teething problems or as more than that?
Sure. So I think the way to look at the vaccine plan to start with is to start with 2 things. One, obviously the first quarter is considerably negatively affected relative to where we were in November by the lockdown. But in fact, we get back to, we've all, as you know from previous forecasts, we've used the sort of end of 2019 as the reference point, sort of pre-COVID read, if you like. We get back to that point in pretty much, in this forecast, in pretty much the same sort of elapsed time as we did last time. So what that means is that, of course, we do have a more condensed recovery. It's the same recovery in a sense, but it's in a more condensed period, and that is reflecting the vaccination. And that does reflect vaccination. So, it is very good news, and I want to obviously, congratulate, pay tribute to everybody who's involved in it. I mean, it's an excellent story, and it is reflected in our forecast. So that, in a sense, determines, if you like, the strength, because obviously then, as we were saying earlier, that's related to assumptions about the lifting of the lockdown. Just to be clear, we don't make any precise point in time assumptions about that, but obviously there's an underlying assumption. But also importantly, our assumptions about people's risk attitudes and their degree of natural caution, because the lockdown is one thing. People's natural cautiousness in the face of this pandemic is obviously another important factor of that. And so the underlying assumption is that the vaccination program assists very positively with both of those. On the certainty, I think the way I would describe this forecast, there is obviously, relative to almost all previous forecasts, except possibly the last one, this is we've still got a lot of uncertainty. I mean, the band of uncertainty is still very large. I think it is, though, importantly, somewhat more two-sided. In other words, talk about risk. There's risk on the downside, but there is some risk on the upside. Let me just comment on that. I think the risk on the downside in particular. Things we've deliberated on a lot this round is obviously the pace at which, the degree to which they will be used in the recovery phase. By the way, I should say that the household savings that are built up are very unevenly distributed, and that's important. Not easy to reach any firm view on this because obviously fortunately there's not many global pandemics that we can draw on for past evidence, but we've also looked at evidence from countries like New Zealand and Australia, which obviously have sort of got are ahead of everywhere. And I think the view is that it's a pretty cautious. There is a drawdown of those savings, but it's not a very large one, and so therefore there is a risk that obviously it could be larger. So there's an upside risk there. On post-Brexit, we, assumed in the November forecast that there would be both two effects. There would be a longer effect from moving to new trading arrangements, and there would be an adjustment / teething effect. And that adjustment teething effect would basically go over 2 quarters, but would reduce over time during those 2 quarters. So far, I think it's fair to say that obviously there's a lot of evidence yet to come in. We follow it very closely, indeed daily. We haven't seen anything that caused us to want to change the assumptions we made in November. So we'd already assumed a reduction in GDP in the first quarter caused by that. Wasn't anything yet to change that view.
Great, thanks.
Thanks, Andrew. Larry at The Guardian.
Can you hear me?
I can, thanks.
Good. Thank you, Governor.
Yes.
Hello, Governor. 2 questions, really, quick ones. One's leading on from your statement about the upside risk from the drawdown of consumer savings. I just wondered whether your analysis of Q4, the slightly better performance of the economy in Q4, materially better, was the result of just firms becoming better at dealing with the lockdown, or whether it was to do with consumers spending more as the economy unlocked in December. Because if it was this latter, that would probably lead you to think that when the restrictions are lifted this spring, consumption might be stronger than you're anticipating. So I'd just like your comments on that. The second one is, I just wondered whether you think it's realistic for the markets to be anticipating negative rates sometime next year, because if you look at your forecasts, by the time banks and building societies are ready for negative rates, the economy is going to be growing extremely fast. So I just wondered how realistic you thought those projections were.
Yeah, okay. Let me start, and Ben or Dave may want to come in on this as well. But let me say on Q4. So the interesting thing is that I think many of the numbers on the economy in Q4 have turned out to be stronger than we expected back in November. Now, we've obviously spent some time asking ourselves the question why we're seeing that. I think there's 2 broad reasons. One, I think there is a general trend of evidence that I'm not surprised by this, that we all essentially adapt to the world around us. So in other words, people have adapted to doing some some greater amount of economic activity and conditions of lockdown. I'd say generally we've seen over the course of the last nearly a year now that the economic effects of lockdowns have attenuated as time has gone on. I don't think it's particularly a story about drawing down savings, but Ben or Dave may want to come on that. The second thing, obviously, to say after that is that, of course, obviously there is substantial policy stimulus in place. I mean, both from fiscal policy and monetary policy. On the markets, I mean, look, I'll just simply say this. We say at every opportunity, and you've no doubt heard us say, I don't know how many times already in the first sort of 28 minutes, that there is no signal in terms of policy setting from decisions that we're taking and actions that we're taking on the toolbox. So, my message to the markets is you really should not try to read the future behaviour of the MPC from these decisions and these actions we're taking on the toolbox. We're being very transparent about the toolbox because I think that's very important. And in any event, to do preparations, with Sam and his colleagues have consulted, have to work with 160 banks, so there's no point trying to hide it. But anyways, that would be wrong anyway. I mean, we're very transparent about this, but nobody should take any signal from this. Ben or Dave, did you want to add anything?
Yeah, could I, just a couple of things, one on each for Larry. It's true that more businesses were operating or fewer were failing to operate in November than in the first lockdown. There were a couple of other things that contributed to that strength. Estimated output in public services suffered much less than in the first lockdown as well, which has less direct relevance for inflation from our perspective. But there may have been some learning. Equally, the restrictions weren't as widespread in November as last spring, or as indeed as they are now. So we have tried to take into account that adaptation. We nonetheless end up with a prediction for Q1, which is of course a much longer lockdown in November, which is worse than November, but clearly a lot better than, or less bad than last spring. On the speed of growth, I'd just remind you of something the governor said earlier, that we're coming from a lower starting point. So, what we care about is the extent of spare capacity, and that will have more to do with the level of demand relative to the economic capacity of the economy. And so in some ways, the growth rate of GDP at that point is slightly misleading. What you have to think of is the level of demand relative to the economy's capacity supply. We do unfortunately anticipate a rise in unemployment, although that we think that will have started to decline before the end of this year. Thanks.
Thanks, Ben. Can I just ask, by the way, if you don't strictly need your video on, if you could turn it off, it just might help us with some of the bandwidth issues we may have been having, although I can hear everyone fine at the moment. Russell Lynch at The Telegraph. One moment, Russell, I can't hear you at the moment.
Can you hear me?
I can now,
Yeah,
thanks.
very well, Russell, now, yeah.
Just a couple of follow-ups on negative rates. The lesson from Sam Wood said that it talked about the material risks to safety and soundness from a move sooner than 6 months. I just wondered if you could give us some colour on that, the very particular challenges faced by the banks. Also, I know that this was an operational review about the feasibility of rates, but has the bank come to any conclusions about things like the reversal rate and how low the rate could go if you indeed chose to use that tool?
Yes, thanks, Russell. So the material risks that Sam was talking about are operational risks. I think as Sam's letter said, I mean, there's obviously a range of responses to the question of, how ready are you to put a negative number into systems? Not surprising, really. I mean, some systems were probably designed with that thought in mind and some were not. And so the risk to safety and soundness is very much an operational risk. And it's the operational risk of obviously doing changes to systems without doing the rigor of testing, trialing, and so on that we expect. And obviously, as we know, sadly there's some rather well documented and much publicised examples of banks doing changes to their systems and getting themselves into quite difficult situations and having outages that are obviously very damaging to the customers and ultimately to the banks themselves. So we don't want to obviously cause that to happen. So the material risks are all around that. They're all around this question of, what do the banks need to do for this so-called tactical set of fixes. We're not obviously asking or expecting banks to sort of rip their core systems up and put new ones in. And that's where the judgment that for a sizable number of firms doing it in under 6 months would give rise to too many of those risks. Reversal rate, no, we haven't actually. That's not a subject that we've so far really spent any time on. I mean, obviously it's a well-known phenomenon. It's related to the presence of cash economy, but that is not something that we have spent time on. There's a literature, obviously we've all read the literature out there, and there's an extensive literature out there, but that's it.
Thank you.
Thanks, Russell. I think we've got Jemana now at CNBC.
Hi there, can you hear me?
Yes.
Loud and clear, thanks.
Great. I wanted to ask you about the QE envelope. You increased the size by 150 billion pounds at the November meeting. And if you look at the pace of buying over the last couple of months, you've been averaging purchases of around 4 to 5 billion pounds. So it doesn't seem like you're going to be using the full envelope. Is that the right takeaway?
Dave, would you like to comment on that one?
Yeah, can you hear me okay, Jemana?
Yes, I can.
Great, thanks, Dave.
Yeah, so when we embarked on this program, back in November, 150 billion program, MPC wanted to hit that target around the end of this year. We were clear at that point that we would continue with the pace as was, and we've reiterated that again today to take us through to the March meeting. So as you say, about 4.4 billion a week. But then at some point, and we're reviewing this at each meeting, we do envisage, subject to market conditions allowing, slowing the pace somewhat, which is what we would do in order to hit the 150 billion target increase by the end of the year. So there's no suggestion that we're coming up short in any sense. We're very much on track to complete this program at the end of the year. If we continued at the current pace, we would actually complete the program a little bit before the end of the year. We've already done about 15 billion or so. So we do need to slow the pace somewhat at some point, but at the moment we're carrying on at 4.4 billion, and the arithmetic that we're working to is very much consistent with meeting the full 150 billion at the end of the year. Thanks.
Thanks, Dave. Ben at The Independent.
Hi, can you hear me?
I can, thanks, Ben.
On the question of negative rates, a lot of analysts were suggesting that if the bank was going to do negative rates, it would be a no-deal Brexit that would force its hand. I know you don't want to take the prospect off the table, but would you like to comment on that widespread assumption that the risk of the bank doing negative rates has diminished because we have got a Brexit deal? And also earlier you suggested on the question of uncertainty that uncertainty, while it's still high, has receded since the last bank meeting. Is that correct? And is that solely because of the vaccines, or are there other factors as well?
Yeah, thanks, Ben. Well, I think on the question of Brexit, I would just come back to the point I made earlier, which is that actually our assumptions on the impact of the trade deal, now that we know it, are exactly the same as the ones we made in November when we were still waiting for it. So its role really hasn't changed, in the role in terms of the forecast, in other words, hasn't changed in that sense. So, honestly, I think that speculation that Brexit was going to be the thing that would force our hands quotes on negative rates was always, interesting. And so, I think all I can say on the impact of Brexit is that actually, we haven't changed our assumptions. On the question around uncertainty and has it evolved, I think it has. Obviously, let's take one thing. Obviously, the degree of uncertainty around the trade agreement has reduced because we obviously do now know what it is. So that's one area where I think can reasonably say that there is less uncertainty than there was back in November. And as I said earlier, I think a part of the forecast is that uncertainty over the path of the forecast now reduces over the path of the forecast, with the assumption being that the vaccine, obviously the vaccination program is successful, it's going very well, and that its impact causes a reduction in uncertainty. And as I said before, it's not just in terms of things like the lockdown, it's also the uncertainty embedded in people's reactions to it and how that comes out in natural caution. So I think it's reasonable now to see we're still living in a very uncertain world. Don't get me wrong, but it's reasonable to see over time a way to a reducing path of uncertainty.
Thanks, Andrew. I think it's Phil at the Times. Phil.
Good afternoon. Can everyone hear me?
I feel, yeah, very well.
Yeah. Just two quick interrelated ones. You mentioned the upside risk from the household savings being spent more aggressively than forecast. I wondered what the policy implications of that would be if it is significantly stronger than expected. And what gives you confidence that business investment is going to swing in behind the consumer? Have you seen stuff which is promising there?
I might get Ben to talk about the upside risks on saving. On business investment, just saying the forecast, business investment, recovers much more slowly. So we have in the early days, as it were, the faster recovery is in household consumption. And if I could just sort of step back for a moment and say, we've had weak investment in this country, weak business investment in this country for quite a long time now, let's face it. And I do think, and it's a very, very high priority for me, that one of the things that we need to work on and see happen in this country in the coming period is stronger business investment for all sorts of reasons. But obviously that will be an important part of underpinning growth. It's an important part of the COVID recovery. It's an important part of the response to the structural shifts that which will to some degree happen in the response to COVID. Ditto, obviously, the adjustment of trade panels that we expect with Brexit. And let me say that one of the very important things, and you'll have seen this in the FPC's record, but it's obviously relevant to the MPC as well, is the work the bank is doing with the Treasury and the FCA on so-called productive finance. In other words, doing everything we can to unlock the supply of finance to support business investment, which I think is a very, very high priority going forwards. Ben, did you want to come out on the actually?
Sure. Just on the savings judgment, we've treated in the forecast like an increase in household wealth, which it is. And if you look at the estimates of spending out of that wealth, 5% on annual spending is in the middle of that range of estimates. There might be some upside from that because these are generally liquid assets, bank deposits essentially. On the other hand, they're also skewed towards people who probably in general spend less out of increases in either wealth or income. So there may be risks in both directions. Obviously, were that to occur, where they were more of it to be spent, then the demand forecast would be stronger. But I think committee's view was that 5% was a reasonable number, given the risks on either side. Thanks.
Thanks, Ben. I think Oscar, you're next up.
Hello.
You're off mute now. Yep, go for it.
Can you hear me? Oh, fantastic. Slightly different question from me. Obviously, over the last week, we've seen a lot of exceptional moves in some retail stocks over in the US, and there's a report out this week suggesting that about 400,000 Brits got into investing for the first time last year, more likely to be young, furloughed, and male. Is this on the bank's radar at all? What the dangers of a possible inflation of a bubble or bubble-like movements happening for UK investors, be it seeing some of the moves moving across to the UK, or UK investors getting exposure to US stocks? And more broadly, would you have any sort of message for these people who are starting to stuck at home and starting to go to the stock market? What's the bank's thoughts?
Yeah, well, let me be brief. I think it's really more of a financial policy committee question than a monetary policy committee question. But let me just put that hat on for a moment. It's obviously an interesting question, which we've been watching carefully. I mean, and by the way, obviously, I'm no longer CEO of the FCA, who are the lead authority on conduct. But I would say this: that I mean, what we can observe from the US trading patterns, I'd say a number of things. I mean, it is very striking, actually, if you look at a chart of trading volumes in US equities over recent years, how much they've gone up in the last year, and actually how much they've gone up since the start of the pandemic. Now, I'm not implying causality there, but I mean, it is an interesting, at least correlation. I think you're right to point to the risks. It appears that there is very high leverage among many I think retail investors in the US and maybe around other parts of the world as well. And obviously that is very high risk, and that puts investors at very high risk of losing their money, frankly. I would also point out two other things which are more market points. One of the things we do have to watch is this whole question about margin calls on retail brokerage platforms. Clearinghouses, of course, have to make margin calls. That's entirely the right thing to do. But the retail brokerage platforms have to be ready for those and have to stress test their own positions. And obviously, the substantial price volatility and the very high level of volume has caused those margin calls to happen. And as has been well documented, has caused retail brokerage platforms to have to raise money themselves at short notice. So that obviously has the potential to disrupt what I might call the retail infrastructure. The final thing I'd say on it is that I think what we've also seen over recent times has been more concentrated hedge fund positioning. And that's interesting because, of course, that more concentrated positioning does increase vulnerability to short squeezing. Now, we have to be careful here about what's going on, but and there'll be much more analysis to come. But it is interesting that this activity has come, maybe you're right to say, with the sort of change in people's living regimes, as it were, but it's also come in a period of what appears to have been more concentrated hedge fund positioning. I think I wouldn't go further than that because there's a huge amount, no doubt, we're going to learn about this in time to come.
Thanks very much.
Sure.
Holly at Press Association. One second, Holly. Yeah.
Can you hear me? Okay, brilliant.
Yeah, very well, very well.
Hi, Governor. First question, just on unemployment, actually. It's apparently been better than expected or better than feared so far, but obviously it's been cushioned hugely by the furlough scheme. I'd just be really interested to hear a bit more on the bank's views on this and the suggestion that a lot of people on furlough will be able to go back to their jobs once the furlough scheme ends. But how confident are you on that? And what are your thoughts on possibly seeing a real tidal wave of job losses once that ends?
Well, let me start. So I'm sure Ben or Dave may want to come in. So, I mean, let me say a couple of things. So the furlough scheme has played a very important role, no question about that. I think it's been a hugely important part of the policy response. The second thing I'd say is, as we've said before, I know, and I'll have to say it again, I mean, The labour market data are the hardest at the moment to interpret. And by the way, labour market data all round, we've spent a lot of time in this round interpreting not only the quantity data, right, the employment, unemployment data, but actually also the price, the earnings data, which have also been quite strong actually, and interesting question around the role of compositional effects in that. I mean, on the whole, we still think that the underlying or the unemployment rate is higher than the reported one, and we draw that from particularly the alternative series, particularly the HMRC series, which gives you a read on jobs lost, for instance. So I do think currently the rate is higher than it is reported. And that's important because, as you'll see from the forecast in the report, we've got a pickup in unemployment. It doesn't last long, but it does pick up. As there's a sort of an adjustment as the economy starts to get back going. And of course, sadly, some parts don't. I would, however, say one cautionary word, that the scale of that pickup, I say, has to be calibrated in terms of where we start from. And we probably start from a higher level. But as you said, don't take it away from it. The furlough scheme has been a very important part of the policy response. Ben or Dave?
Thanks, Andrew. Yeah, just to reiterate Andrew's point about difficulties in measurement and difficulties indeed in conducting the labour force survey, which is the one that gives you the official unemployment numbers. There's a chart in the report on page 24, I think, showing the contrast between employee numbers as measured in the LFS and the readings you get from those HMRC sources about how many employees there are. And that's why we think probably the number has been slightly higher than the number of unemployed. And indeed, the ONS itself has said that the HMRC series may be a better guide right now to those employee numbers. As far as the forecast is concerned, I mean, we've had pretty much the same projection for the peak rate of unemployment, around 7.75% for the last 3 MPRs, including this one. So it hasn't changed in that sense. It's just moved slightly to the right each time because of the extension of the furlough scheme. But it's a key number in our forecast for inflationary pressure. And as Andrew said, that's why the furlough scheme has been so important. Thanks.
Could I just add, Seb, that as Ben was just saying, it's the peak level of unemployment has been a pretty constant feature, and then is in recent forecasts, and then is followed by a pretty sharp fall in unemployment over the rest of the forecast horizon as the economy picks up, and that will be important to ensure that the short-term unemployment doesn't turn into longer-term unemployment. And although that is a forecast judgment, and as with previous forecasts, or certainly the last forecast, that we do see the risks that there could be slightly more persistent unemployment not falling quite as sharply, but that will depend on the speed of the recovery, and also the ability of people who've unfortunately have lost their jobs to move into different jobs. PC very focused on these labour market developments. Thanks.
Thanks, Dave. Harry Robertson, are you on the line?
Hi, yeah, can you hear me?
Very well.
I can indeed.
Hi, Governor. My question's about the bond buying package. Governor, you mentioned last year a couple of times that you would be taking a look at the bond buying package in relation to climate change. And you suggested that would be something that you'd take up with the Treasury, who set the bank's remit. There's the budget coming up in March. Will this be something that we'll be seeing talked about in the budget? And do you expect there to be action on that in the first half of this year?
Well, we'll have to see what's in the. I mean, we do, as you rightly say, we normally expect a remit letter around the time of the budget, so we'll have to wait and see what's in that. You know, that's we're just under a month now, so we'll find out. We are working now on the question of how we would, in a sense, arrange and structure a bond portfolio to achieve a climate objective. And I say that because, bear in mind, let's start from where we are today. The corporate bond portfolio we have today is constructed on a strictly neutral basis. I mean, we essentially buy a neutral weighted representative sample of the market for companies that essentially pass, you know, credit rating conditions and other associated conditions that we've set, but we're neutral. And that's important, and we would want to be neutral under any what I might call public interest objective that we set going forwards. So the task for us, much like some other central banks, is to define what a workable neutral benchmark would be, or neutral measure would be, that would work for, in a sense, a bond portfolio which is neutral but is let's call it from shorthand climate adjusted. And the only thing I would add to that is a point I may have made before, but I'll take the opportunity to make it again. In setting that structure, my view is that we want to create the incentives for companies to meet the targets, to meet the adjustment targets, to meet the requirements on transparency. So, you know, I very much hope that we will see TCFD adopted, become a requirement. So we will work on constructing a benchmark, if you like, which has the characteristics that it meets the public interest objective of climate change and sets the right incentives for companies to meet it. Because I don't just want to. I mean, we don't just want to say we've got to meet it today, because unfortunately, you know, many companies are on a journey, quite understandably, and we want to encourage that journey because that's the way we'll achieve the overall objective and target.
Thank you very much. Ed Conway, sorry, I missed you earlier.
Hello.
Hi.
Hiya. Can I ask a slightly pointed question on interest rates? So last year, obviously, you cut interest rates down to 0.1%, but rather than falling, mortgage rates have, as you will have seen, have risen. Yeah. On most types of mortgage rates at the moment have risen since then. So I suppose the question is, you know, to what extent has that unsettled you? I mean, I'm sure you'll say, well, they would have risen higher were it not for us to cutting rates. But to what extent, you know, has it unsettled you, the fact that, you know, that question of the transmission mechanism and the power of bank rate? And then what bearing does that have on, you know, on negative interest rates? If you're not able to get interest rates down as much when they're still in positive territory, then what's to say that you're not going to have exactly the same problem when they go into, or if they were to go into negative territory?
Well, no, it's a really good question, Ed. I mean, what we've seen over the last year, so it's not a generalised rise in mortgage interest rates. It's actually quite a mixed pattern. But you're right that particularly for the higher loan-to-value mortgage interest rates, we saw two things. We saw quite a strong withdrawal of product from the market. That's actually been pretty clear signs that's reversing now. And we also saw an increase in rates for those products that stayed in the market. Now, I've got to be honest, I mean, what's that telling us? It's telling us, of course, that the lenders have changed their view of the risk premium, if you like, on that sort of lending. That's not, I think, hugely surprising in many ways, because, you know, certainly in the early days, and let's go back to before the stamp duty measure, but the stamp duty measure is, of course, obviously temporary and it's coming towards the end. You know, given the scale of the downturn, you know, it was not unreasonable for a lender to think that there was a much greater downside risk on house prices, and for that to naturally feed through to high loan-to-value mortgage rates, both the availability of the mortgages and the pricing. So I don't see that as a failure of monetary policy. I think it is a natural, if you like, product of an environment in which there was A, a big downturn, B, so much downside risk, and C, so much uncertainty. I think we follow it obviously very closely. We're beginning now to see an evidence of product coming back into the market. And I would expect that then to be reflected into pricing. So I think the story is around perceptions and therefore actuality of the risk premium in high LTV mortgage lending. And it's, you can tell, I think, a pretty consistent story around why it happens.
Thanks, Andrew. I think Bill at Reuters.
Hi, yeah, can you hear me okay?
Can do.
Hi, Bill.
Hi. The minutes had a paragraph about the committee asking the bank staff to start working on reconsidering the previous guidance for the appropriate strategy for tightening monetary policy should that be required in the future, end quote. Why the need for new guidance, and does this reflect the approach of a time for tightening?
Right, so as with negative interest rates, there is no signal here. This is another toolbox issue. The simple point I'd make is this, that the last time the committee considered this question, if I'm right, my memory serves me right, it was in 2018. The world's changed a lot since 2018. The Bank of England balance sheet has changed a lot since 2018. Obviously, we've had to use QE more than we've ever done. And as I say, with no signal whatsoever, I think that it is important that we now start to consider the issues that give rise to that, that gives rise to, sorry. It doesn't mean that we will change the view that we reached in 2018, but it does mean that there's so much has happened that it is something that we appropriately need to start to give consideration to. So that's what lies behind it. And again, monetary policy has in a way become more multidimensional, as I said in my opening remarks. We have to consider these so-called toolbox issues. I think we need to be transparent about them, but we also have to be very clear there is no signal in them.
Thanks, Andrew. I've got a couple of hands up remaining. I've probably got one more question time left. Larry, did you have a question?
I'd have one actually, so I'm fine.
Yeah, so I've just still got a hand up. Okay, I think actually everyone else I can see here has actually asked a question, so I might close things there. And apologies for the technical problems at the beginning. I've gladly been resolved, and particular thanks to my colleague Michelle, who's on the line somewhere, for fixing them. So thanks, Michelle, and thank you everyone for joining the call, and speak soon.
Thank you.
Karine, je commence un Facebook Live là. Je suis occupé pour quelques minutes, désolé. Ok. Nine.